I have a prize for somebody that I want to start with something a little fun. Does anybody know what significance March 2nd is? There you go. See there, Texas Independence Day, prize one. There will be many prizes given out tonight, by the way, so participation. I am going to, as I said, welcome a little bit about the agenda. What I'm going to talk about first tonight is the rental assistance program. In fact, I might even ask one of our experts here that can help me if you have any questions about it. But the rental assistance program is the $1.4 billion relief fund that the state of Texas has put out to help us and help those who probably owe us some money at the properties. It, unfortunately, like a lot of government programs, had its problems getting off the ground. The website didn't work for the first 10 days, and we couldn't upload any documents. They pushed it out and said, okay, you got another week to get them in. So we're still working that progress. But just kind of want to give you a quick update about the rental assistance program. Then we're going to talk, I'm going to give you a winter storm update because I know all of you are just absolutely dying to know about how your property fared during the winter apocalypse. I believe it was Dillard that first coined that term with me the other day. Snowmageddon, winter apocalypse. What? Snowvid? Okay. Well, I'm sure you all lived through it. I hope you were not too adversely affected. We did have some properties that were hit a little harder than others and some that were just totally unscathed. So we'll talk about that a little bit. And then Darwin's going to come up and talk about current opportunities. And then really tonight we're going to leave a lot of time for question and answers because it has been a full year since we've seen you guys. Beautiful smiling faces. Before I start this, I want to have a little fun, if you don't mind. Those of you who have been to our meetings before, I like to do a little bit of something called Did You Know? Did you know? And tonight, by the way, if we have any medical people in the audience, you can fact check me, I guess, but we're going to focus tonight on three things that did you know you had a body part called this? Okay? Not that bad. Did you know the space between your eyebrow is called a glabella? So this right here, it's called a glabella. Now I just hit enter. Okay, how many knew that? I had no idea. Did you know that the rumbling of a stomach is called a wumble? These are facts, by the way. I got them off the internet. These are not made up. Did anybody know that? So do we have any medical people that are fact checking me here? What is this? 0212. Enter. Did you know that the space between your nostrils is called the columella nasi? Anybody know that? Tracy knew that one. Tracy knew that one. I honestly did not know any of these, but I did a lot of research on them. Did you know, and I bet you all of you in the room know, that Darwin German Real Estate distributed over $31 million to its family of partners over the last 3 years? So 2018, 2019, 2020. This does not count anything that's happened in 2021 yet. So congratulations, all of you, because you're all a big part of that. But, of course, the question is, does anybody remember what the question is? Did you get yours? Somebody said it in the back. Did you get yours? So, again, we could not do this without your participation, so thank you very much. We just wanted to kind of start off with a little bit of fun. Now let's get into some serious business. Talk about the qualifications of the Texas Rental Assistance Program. And I'm going to leave, Darwin, by the way, I'm going to leave you, you're going to introduce the team. So I'm going to let you, okay, well, I'll do that. You have a slide on here for that anyway, but we'll just skip over that. So for those of you who don't know, Darwin German's in the back there. Raise your hand, Darwin. Darwin, let everybody know who you are. That's Darwin in the back. The great-looking guy over here holding up the wall, Julian Alexander. Everybody probably knows Julian. Just what? Okay, I'm sorry. You kind of met Ben Mandelstein at the beginning of the meeting, the newest co-sponsor to our program. A lot of promise there. I tell him all the time, had I started when I was 27 years old, where would I be today? But congratulations, Ben. And for those of you who were here a little earlier, Ben closed on the first deal yesterday at Village Condos in Waco, Texas. Dillard Stone. Dillard's responsible for your distribution checks, for lack of a better word. He processes the file and then sends them out to the manager so that your monthly distribution checks can go out. So thank you. If you're on ACH, that's great too. We love ACH. But and then last but not least, the newest member of our team, I'd like to introduce Jessica Hammerbeck. Back here, Jessica just joined Darcourt Management as a regional manager. In case you didn't know, if you count the Tahoe properties, we're up to 21 properties now. So we're growing. We needed some help. We brought Jessica in. She hit the ground running, and this is a really perfect timing because she's been actually put in charge of kind of our Texas Rental Assistance Program and implementing that, weeding through all of the fine print, making sure that our managers understand what documents need to be gotten in so that we can upload those files. And as I said, like most government programs, had some issues. Here there are five criteria that somebody has to meet in order to qualify for the Texas Rental Assistance Program. And I'll say this up front too. You know that we record every meeting, and we're going to send this out to you. So, the first is you must be seeking rental utility assistance for a primary resident in the state of Texas. Okay, household income must be less than 80% or less than adjusted median income. Okay, and this is one of the things we're dealing with today. What happened is when the good news went out that, hey, there's a relief package out there, some tenants, not a lot, but some tenants said, oh, there's a relief package. I don't need to pay my rent anymore, right? It's been kind of a constant communication, let's just say, because we need to let them know who qualifies, who doesn't qualify. We had a finite number of people that we felt like we need to go through the process. That number has increased a little bit, but Jessica's taking care of it, and the bottom line is we're going to help everybody that we can by helping them understand the qualifications, helping them get their documents in, whether it's their W-2s, their unemployment, you name it. We're just being as proactive as we possibly can because our intent obviously is to help them pay their rent. We can go back 9 months. We can go back 11 months. I'm right. We can go back 11 months and 2 to 3 months in the future, and it can be rent and or utilities. It can't be anything else. But again, that's a process that we're going through. It literally just started. Yesterday was when applications started actually getting uploaded to the Texas website. So they're just starting that process. They are absolutely going to focus, just so you know, this says 80% or less. They're going to focus the first round, the first couple of weeks, they're going to only do people that are 50% or less AMI to focus most of that money there and put it where it's needed most. Then they'll go to the 80% level. So we're submitting everybody that's 80% or below. We're not just focusing on 50. We're doing everybody. They must demonstrate that they are either at risk of homelessness, instability, with past due utility or rent notice or eviction notice, or living in unsafe, unhealthy conditions through attestation. Certainly they're not living in unhealthy conditions in our property, so that's a kind of a moot point there. Number 4, one or more of the household members must have either qualified for unemployment benefits. That's a biggie. So they've got to supply us with the unemployment benefits paperwork. Can attest in writing that due to or during the pandemic, they experienced an income reduction in household or incurred significant expenses or experienced a financial hardship. I will tell you that one of the things that's a little unique about this, and that, again, we're putting on our smile faces, but here's kind of the way this program has been set up. For months, potentially, in fact, up to a year, we have a couple of residents have been there for a year that have not paid rent in some cases that we have not been able to get out because of the eviction moratorium. So what has happened is the government in the state of Texas, in its wisdom, has kind of set up an adversarial relationship where for a year we've really been trying to work with them to get payments from them or, quite honestly, to get them out, one or the other. Now we need to be best friends. They cannot go and apply themselves unless we attest that we are not willing to help them. At the same time, we cannot file an application for them unless they agree to supply us with the information, all of the documents, and sign the application saying that we can apply on their behalf. If we apply, guess what? The payment comes directly to the landlord. Again, they can't do it themselves, or there's going to be a time period where they can go back and do it themselves. 21 days, I think, After 21 days, if we're not willing to work with them, they can then go back and apply themselves, and the payment would go directly to them. We're obviously going to help everybody we can in those first 21 days. They must also certify that they have not or will not receive duplicative assistance. If they've already received some assistance somewhere for those payments. Let's say they received money to pay April, May, and June of 2020. They can't be applying here. Okay? They can't get the same assistance. So hopefully I'll give you kind of an understanding of what it is. Jessica's working really hard to make sure. My Siri is asking me what I want. Okay. Anyway, it's a good program. There's $1.4 billion out there, as we're telling the residents. Remember that a lot of people got help during the first round, and that was only $144 million. So this is 10 times the amount of money. We do anticipate a lot of help being out there. It's literally just weeding through the process. You got to vet each individual person. And again, it's a little bit ethereal here because they may not qualify today, for example, but they could have qualified maybe for April, May, June, July of last year. So we're trying to collect documents and work through the system as best we can to get as much as we possibly can and help them get assistance. Any questions in regards to the rental assistance program or how that's working? Okay, no? Okay. Let's move on to the great winter storm of 2021. I hope nobody was adversely affected. Hope you had power throughout, had water throughout, no issues whatsoever. Your fireplaces were running, right? Not everybody? Okay. I personally, I know Susan lives fairly close in this area, to be honest with you, which is really kind of befuddling because this building never lost power. So I'm not sure why you did close. We were told it was because of our proximity to the fire station just down the street. That if you were, in fact, if you pulled up a map during the power outages, if you were next to a hospital, within a few blocks of a hospital, and or a fire station or a police station, your power probably never went off. Or nursing home. But if you were outside of those, luck not so good. Having said that, I just want to give you a little kind of what we did. We felt like we were as proactive as we could possibly be. And when I say proactive, I mean winter storm protocols in place and reminders going to the managers and the staff, literally making sure that everybody was prepared. We had all the supplies, your salt, your sand, everything that was needed, extra padding, all of the faucets covered up, you name it. Really our communication to our residents on a daily basis. If we're going to lose power, keep your water faucets dripping a little bit. I mean, just constant communication. Staffing for emergencies. We had people kind of rolling. We're very fortunate in our management team, in our staffing, to have some ex-plumbers. So you can imagine it came in real handy because guess what? Everybody was vying for the same plumber. We have some really good vendors, and they were Johnny on the spot for us. So you can, they basically said, you pay your bills on time, we're coming to you. So, and we do. Every contingency plan that we could think of was put in place. But you know what you just can't plan for? The power going out. If your power is out, and we had power out at some properties as little as an hour, and again, property was relatively unscathed with no issues, all the way up to almost 4.5 solid days, 4.5 full days of zero power. And you can imagine what was happening at some of those. So, again, I'm not going to go into each property, but just know, just like everybody else out there, we still feel, here we are a week and a half past the winter, the snowmageddon, snowvid, whatever you want to call it. While we did have some problems, we feel fairly fortunate to come out of it the way we did. We did not have any deaths, any injuries, and even more, no displaced residents. Okay? We did have some leaks, and when I say displaced, we did have to move some people maybe out of 303 and put them in 104, but we were able to accommodate them. We didn't have to have anybody that had to leave the property and go stay at home. Now, some did when the power went out, but they didn't have to due to the issues at the property. So we're really proud of that. We're really proud of the staff jumping on it, making sure that the water, as soon as there's a leak, what do? You cut the water off, you get the leak fixed. You wait for the next one, pop, pop, pop. We actually got to the point where I had to work with the city on 4 different properties, and we had to cut the water off totally at 4 properties until we could effect repairs and or the power came back on. But again, we had water on hand to give to the residents. We even had a system where they could come and get water to fill their toilet tank. All of those things that you don't necessarily think about, but those have to be contingency plans that were in place, and we felt like we did a really good job on that. Property damages, what were they? Again, I think you could probably hear this from every property owner or maybe every homeowner in the state of Texas, that they had property, ruptured water, or sprinkler lines. By the way, when a sprinkler line ruptures and you have to cut it off, guess what? Now you have to be on the property 24 hours a day, 7 days a week to do fire watch, because your fire sprinklers are no longer functioning. Therefore, you've got to be there 24 hours a day, 7 days a week until the power comes back on, until all your plumbing is fixed, until the water gets back in there. Flooding of walls, ceiling, flooring, personal property. We did have some of that. Again, we feel fairly fortunate that it was not any worse than it was. And those units that were affected, we were able to get them in another unit. Or in some cases, people said, I don't want to leave my home. That's fine. We'll give you a unit so you can take a shower. Okay? Take a shower. You can live in your own, stay in your own unit. It's amazing. Some people just don't want to leave their unit. It doesn't matter how bad it is. And unless it's a life safety issue, we're not going to force them out. Equipment failures. We did have some boiler units that froze, obviously, because the water couldn't move through and the power was out. But again, everything is back on, either some of it in a temporary state right now until the plumbers can come back out, get everything fixed. I guess what I just want to let you know is that your property's fared very well, okay? Didn't lose any tenants. Yeah, do you have a question? Oh, I'm sorry. I thought you were raising your hand. We feel really good about the way things were handled. And again, do we wish that we had no issues? I think we had one property that just had absolutely nothing. That was Southwest. They never lost power. Then we had one that just lost power for about 6 or 7 hours. We had one ruptured pipe there. And then, like I said, up to a total, our highest property had a total of 87 pipe ruptures. But again, fairly minor. Sprinkler system, not water mains, so we could get them turned off, keep people in their residence, and just do fire watch. Here's the great news. As I said, who thought there was going to be some great news come out of this? No bodily injuries, no deaths, no displaced residents, and guess what? We have insurance. That's absolutely right. In all honesty, and again, I hope my insurance carrier's not watching right now, we do not feel like that. There's probably only 2 properties that I feel like right now we may need to file a claim. Both of our properties on the far west side of the Metroplex. I do not believe that, based upon what we know today, that the damage is significant enough for us to have to file a claim on the rest of them, or it wouldn't be worth the deductible. Okay? So that's again, that's great news. So I'm going to ask Darwin, unless there's any questions about the great winter storm of 2021 and or the rental assistance program, I'll be glad to answer any questions that you might have. Yes, Robert. It has some impact once it makes its way through the court, and I don't mean to be cynical, but absolutely it was a good sign. And I'll be honest with you, I cannot believe this didn't happen almost a year ago. With the lobbies that are out there, with as much money as in real estate and in this type of properties, I can't believe it hadn't happened before, and maybe it hasn't. It's just now working its way through. But you're absolutely right. One judge in the state of Texas said the eviction moratorium is unconstitutional, cannot be enforced. Of course, he did not issue an injunction, which means it's still in force until it works its way through the court system. And, you know, it's got to go to the circuit court, and who knows how far it's going to go up from there. I've told my team just to prepare that this is not going away anytime soon. Business as usual, and I think you're right. By the time it works its way through the court, maybe we'll have got herd immunity or vaccination or whatever the case may be, and you know, maybe we'll be out of this. But to answer your question, it absolutely happened. It's good news. I just wish it had happened a year ago. Any other questions about the rental assistance or the great Snowmageddon or Snowvid? Property management. And again, we got a lot of time for, yes. I'm sorry? I do have a lot of pictures that I'll be glad to share. My insurance guy said, stop it. Stop it. I don't want any more pictures. So, yes, we have tons of pictures. It's the same thing over and over, though, Nikolai. It's water running down a wall. It's water getting shut off. We got to tear the sheetrock out. We got to pull the insulation out. I will tell you one kind of funny story, or just my luck wasn't good that day. We had a leak in the ceiling, 3rd floor. I haven't even told Darwin this yet. I was actually on property. This was, 11 o'clock at night at Gold Creek, and I was out there wet vacuuming the next door. We had the guy, while I was wet vacuuming in this one, the water was coming underneath the wall into where I was wet vacuuming. I said, wait a minute, I'm not making any progress here. I real quickly went next door, and there was a leak in the ceiling. Guess what, though? Right above the bathtub. Hallelujah. It's all going in the bathtub. Bad news is the insulation fell out when the ceiling fell down. The insulation clogged the drain. The bathtub then filled up, and it had been going for probably 12 to 16 hours, just dripping over. Let me tell you how good doors we got. I opened that door, 6 inches deep, rushed out at me. It was not leaking out the front door or the back door. It was leaking into next door and next door, going through the wall, but none of it was coming out. And I literally switched gears because it wasn't doing any good to take the water out of here and here anymore. And I didn't have to go into it for an hour and a half, just let the thing run. So I did. Open the back door and the front door, and that's what brought everybody out at midnight, close to midnight. They heard all the rushing of the water and everything else. I said, just let it run. But I mean, think about it. I thought, okay, great luck. It's over the bathtub. Little bit of insulation that failed, clogged the drain, and it let it run free. Kind of adventures in real estate. So anyway, I'll turn it over to Darwin. I think I've already gone through the team, so
yes,
thank you.
Did. Is this microphone on then? Are you good, Mo? Okay, good. Well, we just put on here the whole team of everybody that's there. Obviously, we only have a few of them here right now. Co-sponsor, we talked about them earlier. Of course, Brian Holly, for the people that are still online right now, I'll hit that real quick. Brian Holly, who just stepped down here, was actually my first co-sponsor that I worked with, and that was Riverbend. Reggie, 2405 Park Row, Anand at Southwest. Wes at Village Oaks Condominiums in Dallas. And Ben at Village Condos in Waco. We've gotten a little confusing on that as far as the Village and Village Condos. And also, the newest co-sponsor, you can call him, is my brother. And we call him more of an operating partner because he is heading up everything that's going on up in Tahoe. Who has not heard about Tahoe? Okay, good. We're actually reaching people. That's good. So congratulations first to Ben on getting Village Condos taken care of. He's going to have a lot more videos and a lot more pictures to go ahead and share. And so you'll be getting updates from them. Blue Tahoe, for those of you, I'll reassert this. We already closed on the first property, and we'll go through that. But I want to show you this, give you an idea.
Hello, Charles here. We're at 969 Brockway Avenue. Demolition's going well. We have 8 units we're demoing. We have almost all of them done. And from here we can start stripping the flooring, fix the electrical we need to fix, replace all the switches, all the outlets. With the window contractor, we're going to replace all the windows. This unit, for example, is a 2-bedroom. Once it's redone, it'll have nice new floors, nice new counters, and the rent will go from $975 to about $1,700. And it'll cost $20,000 probably to redo the unit in its entirety. So making a lot of money. It's a lot of work, but we have half of them that are almost finished demolition. We'll start putting them together soon. Once we get the top done, then we'll empty out the bottom and start on the bottom and keep it going through summer. Should have paint, windows. I'm hoping by fall we're 100% done.
Okay, so we are doing a bunch of those. Who does not know? Has anybody not seen the presentation on Blue Tahoe? Huh? Okay, well, I'm going to do the high level thing right here. Again, the whole idea is there's a building moratorium. You can't build there. If you do, you have to buy what's called a residential unit of use, which means you have to buy the developed square footage on another property. That means the driveway, the foundation, whatever. You have to buy each square footage of that, tear it down, put it back to dirt, and you can use that square footage to build your house somewhere else. Okay, so that turns all of that into a huge commodity. So if you want to build another apartment community, it's going to cost you about $50,000 per unit just to buy that residential unit of use. Okay, so not only is there a building moratorium, because of that residential unit of use, the cost of construction is huge. There's also a conservancy. This is a quasi-governmental agency that is buying land, dirt, houses, whatever, and when they do that, then they put a deed restriction saying it can never be developed. Okay? And they own 6,100 acres so far. Okay, so you've got huge barrier of entry, you've got declining supply, and there's only 1,776 units in Tahoe. This is of 6 units or more. Most of these were built most of them in the 70s and early 80s before the building moratorium in 85. Okay? According to their current study, they're 4,000 units short of what they need today. Okay? There's also, these are all mom and pop owners. So, because they're all small units, they're all mom and pop owners, so there's not a corporate style of ownership there. They're all the smaller units, all mom and pop run. And there's also, because a lot of these are in California, there is rent control. Okay, does anybody scared by rent control? Okay, well, you know how much you can raise rents, the maximum? 7.7%. Okay, so that's the rent control. You can't raise the rents on somebody that's living there more than 5% plus CPI. So last year that was 7.7. So we can raise rents on people that live in the units by 7.7%. When we closed on the first unit, the first building, first thing we did was raise everybody's rent 7.7%. Okay, it's a 60-day notice that you have to give them on raising rents. But we hope they move out, because then we go do like he's doing on that unit. We spend $20,000 to $30,000 on that unit and raise the rents almost double. Okay, and so we're buying for about $100,000 a door, including costs, holding costs, because we do vacate them, things like that. It's about $50,000 more, but then it's worth $200,000 a door. Okay, and the whole business plan is to then refinance it after all that's done, refinance it, take that money and reinvest it in another community, another community, another community. We want to get 300 or 400 units up there. So we're looking at being able to buy about one small building a month. And so we need to raise $1 million, $1.5 million a month, okay, to go ahead and do all these. We closed on the first property. That's what they're demoing. We're ready to close on the second one. We still have some room left on the second one, and we've already got the third one lined up. And the one thing that we're having problems with is there's so much flight out of San Francisco and Northern California that it is so busy up there. And now even prices are going up even higher. So we've got to get a move on getting a lot of these bought. And the way that works, because my brother's been investing there for 7 years. 100% of his net worth, except for his house, is in Lake Tahoe. So he's been there 7 years. He knows everybody, knows all the contractors, knows the major brokers, and pretty much anytime he wants to buy anything, he calls the brokers. The brokers track something down to sell for him at that price range. So that one is a great growth fund, and we're projecting about a 20% per year average return once it's all said and done. Okay, a little bit different structure with a pref, because there's not cash flow. This is all a value play. It's all a value play. And I put rents are 30% low. Obviously, like on that one, going from $860 to $1,700, it's a whole lot more than 30% low, but we wanted to be conservative. Yes, sir. California capital gains, yep. But we're planning on holding long term, and at that point in time, so we have an extra tax. So, I mean, it's still, I'll pay the tax on that gain. You know, I don't mind, and then who knows, maybe we do a 1031 exchange at that time. But the whole idea is to run these as a corporate entity, have economies of scale by having numerous units, control the market, and then sell to a larger player who would want to come in and do that. And you got to remember, up there in Tahoe, you've got Harrah's, Harvey's, Hard Rock. You've got these major casinos with a lot of money invested in there. So there is corporate money up there. It's just not in housing. Did you have a question, sir? How many years? We're planning on a 5-year hold. 5 years is what our planned hold is. Now, if something comes in earlier, we're very opportunistic. If an opportunity comes to sell earlier, we will. Okay. It's basically 100% return, yeah, 20% per year over 5 years. And it's a fund, so it's all the units are owned together. That way we have, one of the benefits is that every time we buy a new property, we are putting a little more in our operating fund. But once we get $300,000, for example, we don't have to raise that part of the operating fund on a new deal. So it'll be a little bit cheaper per unit as we move ahead.
Yeah.
So Blue Tahoe, if anybody wants in on that, we're ready to close our next property. So go ahead and talk to the investor relations team, and they can get you hooked up on that. Like I said, I think it's a great deal. The next one we're going to be rolling out is the Crossing. Okay, this is an interesting story. This was the first property that I ever syndicated, ever. I mean, I did some small partnerships with some people before this, but I learned about syndication, and why did that go off? Any idea?
Probably it's your computer that timed out.
No? Computer's on. Either way. How many of you are members of Lifestyles or were members of Lifestyles? Look at that. Everybody spend $20,000 to join? Okay. Well, I actually went to Lifestyles. I heard about them. I went there in 2008, and I thought, oh, syndication, this is a pretty cool idea. So I said, let me see if I can go do one on my own before I pay to join and learn about how to do it. I'd rather learn by doing. So I went out and I syndicated this deal. I had to raise $1 million. I had no idea how I was going to do it. I was terrified, and went ahead and bought that. $1 million down and $1 million note. So $2 million for this 100 units. 20 grand a door, 2008, right after the crash. Okay. We held on to that for about 4 years, till about 2012, and it was about time to turn that money over. So I said, there's still a lot of meat on this bone, so I sold it to a new partnership that we formed, a new syndication, and we did that. It's basically recapitalizing, because we had already done a cash out refi, we couldn't do another one, so we sold to a new partnership and did that and held on to it. There was a lot of meat on the bone. So we bought it for 2, sold it for 6, and now we're turning around and we've held it now. Wait a minute, bought it 2012, and then we refinanced it in like 2016, held on to it. The investors on that deal have already gotten over a 300% return, okay? And now we're gonna sell it again, this time at $8.2 million to a new partnership. And the reason that we actually have to do it, we have to sell the property now because the age of the property, all of the cabinets need to be replaced. If you replace cabinets, you have to do counters. If you're doing counters, you got to do the sinks and the faucets. If you're doing the sinks and faucets counters, you also have to do the appliances. And wow, you've got this great brand new kitchen. Well, now all of the old patched texture and everything, that has to be redone. Well, we're redoing that. You got to put in new flooring. Well, we've gone this far. What the heck? You got to. So it's everything. It's doors. It's hardware. And so we're looking at a $20,000 a door CapEx project. So we need to fund that, and our current partners can't fund that. and don't want to. They'd rather take their money and move on, and we can go out and get new debt by rebuying it. So this is a property, we know where all the bones are buried. We've owned it since 2008. So it's still got a lot of meat on the bone, and it's been a cash cow for us. So we're going to turn around and rebuy this. And so we're going to raise $3 million for this particular property. It will be a 506B, so we can have non-accredited, so we don't have to have accredited people in it. So this is the next capital raise that we're going to be doing. And like I said, we're going to raise $3 million. We should be able to do that pretty quick. So if you're interested in that one. Saginaw Crossing. Okay, Saginaw, if you look at a map, is inside of Fort Worth. Okay, if you look at Fort Worth, there's a loop 820 right around Fort Worth, and this is on the north side. It's just north of 820. If you look at it on a map, it's about the same level as Loop 12 from Dallas to Loop 12 and Fort Worth north. It's about the same distance. Okay, so it's pretty close to Fort Worth, but it's in the city of Saginaw. And this particular property, you get off on 820 on Main Street, and as you drive up about a mile, and that's where Saginaw starts. And this is the first property as you enter Saginaw. Okay, so it's a good deal. We've already replaced virtually all of the air conditioners, and it's in great condition. Just needs to be updated. So we're going to do an update program on that, and there we go. And so we're projecting, it has a year one cash flow of 5.1. This is to the partners. This is not the property level. This is partner level. Year two, 6.2, and years 3 through 5 over 10%. Because it is a bridge loan, we're buying that, fixing it all up, raising the rents, putting all the money into it, and then we'll refinance after year two, sometime during about year two. And there's very, very little cash out. Not even enough to really even get excited about, but then the cash flow jumps up because we'll have a lower interest rate loan rather than the bridge loan. But total average return 16.3 projected. Okay, who wants that? Okay, 3 of you, good. Oh, 4. So that's the crossing. Those are 2 deals we're doing. Yes, sir.
Go back to Blue Tahoe for just a second. The question popped into my head. How are distributions, dividends, whatever we're getting back being reported? Are we 1099s or K1s or what?
K1s. It's all K1s. Yeah. Tax questions, my least favorite questions.
We do not give tax advice. We
do
tell
not
you to seek tax advice from your professional
CPA.
taxing.
If you want one, there's a couple in the room. So they can give the tax advice. Distributions are as we can, because when we buy a property, we pretty much want everybody out. So it takes about a year to go through and do that and lease it back up. So we're not projecting any cash flow year one. Okay, but then after we refinance, then if we have another property to buy, we'll take that cash and buy another unit with that, so it grows your equity rather than distributing it. Okay. 5 years until we sell the whole thing. There will be, depending on how many we're buying and how many refinances, how quick we do all that, the whole problem is that's when we start paying distributions, is when the cash flow can justify it. But we do have a preferred return of 7%. So no matter what, you're going to be earning 7% before we get paid anything. Okay? Minimum 50. And I think if you're going to do, I mean, if there's some people that have spread that out, saying they'll do $25,000 a month, you know, for 4 months or something like that, and they've done that so that they can be in numerous deals and just spread it out. And crossing, we just talked about that one. So now's the fun part where it's opened up for any questions about anything we're doing.
And the whole team is here to help answer any questions.
Well,
we know it's been a full year since we've kind of gotten together. If you don't mind, we have a lot of people online on the Zoom meeting, so I'm going to hand you the microphone so that everybody can hear the questions.
How did you know? I wanted to ask about Villa Creek, get kind of a catch up on that. Is it still moving along?
Okay, Villa Creek. We had our call for offers 2 weeks ago. Then we had best and final last week. And we had 3 standout offers, well above our original thought process of where we thought it would be. And what we did is we sent out a contract to all of them last Thursday, saying here's the contract, mark it up so that we know where you would be coming from. Because sometimes you pick who you're going to go with, and then they drag out the contract process. So we said, forget it, let's get it out of the way now. Let them negotiate the contract, see what they're going to come back with before we pick who we're going to go with. And those were due at 5 o'clock today. Okay, so we'll have an update from the broker tomorrow with the contracts so we can pick on that. Now, it's looking like I'm gonna give you a low estimate. The low estimate is an average of 45% per year return for those in Villa Creek. Yeah, 45%. Yeah, where can you get that?
Annual rate of return.
Average annual rate of return. So, what's that?
How long do you have that one?
4.5
April
years.
2016. April, actually 5 full years.
Yeah. He remembers things so much better than I do. He's got one of those eidetic memories. It's so annoying. Jessica's nodding. She already knows it.
Yeah, she's already made a comment. Any questions about anything? Again, you know this. We're a total open book, so.
Yes, I have a question about Brookside. What's the plan for it?
Brookside, we're actually working with a broker, and as of an update today, is we haven't actively marketed it. We haven't listed it, but we've had brokers looking at it, and Wes, one of our co-sponsors, who's a broker with Marks and Millichap, they are marketing another deal, and they've got 3 preemptive offers on another deal that they're doing with $1 million hard each on that property. So, and it's a similar property, similar area, and so what we're hoping to do is after they pick the horse they're going to take, then we can go back after the other 2 of those to see if they'll come over and look at that. Because we would like to sell it, and the big problem is our defeasance. So rates have ticked up a little bit, so that helps on our defeasance, doesn't hurt as much. So it'll either be an assumption or defeasance, so we've got prices for either one of those is the assumption or all cash. But nothing active yet, but we're still working on it. Shh.
Questions?
On that last slide, the apartments you're reoffering.
Yes.
So, after the capex of $20,000 a door, is there something that expects the rents to raise or something to give you that 16%?
Yes, we are going to be raising rents, and we wanted to be very conservative. I think we only budgeted like $76 rent increases after putting that amount of money into it. And also dressing up the outside and things like that. We wanted to be very conservative. There's not a lot of comps for that particular property because it's all bills paid, and in Saginaw, there's a couple of newer properties, built in the early 2000s that are tax credits, but there's nothing else that's all bills paid. So we're being conservative on what we think we can raise rents after we update it. Do we have somebody online that can read off questions that are online?
Yeah, Jeremy's going to collect them, and then I'll let you know.
Okay.
I'll be right
Off
there.
from New Jersey.
So, Darwin, I think last meeting or maybe 2 meetings ago, a year and a half ago, you had said that you guys might be looking at more office spaces like this building as opposed to multifamilies. So since the pandemic, and companies maybe realizing that they don't need office space, has that been maybe a shift back towards you're looking for multifamily?
We've always have been and always will primarily focus on apartments. If there's an opportunity that comes up on an office building, then we would look at that. But we're not actively pursuing that, and with way that office space is right now, it's still on a downward slide. So we don't want to open that. We don't want to take that risk. And the only way to analyze an apartment like an office building like that is take all the rents for the entire office building and basically take what we think market rent is and drop those rates 20 to 30%. And then if it makes sense, then we'll look at it. But nothing is, because sellers are still going to want high dollar for everything. They're still going to say, hey, it's all going to come back. They still need office space, et cetera. So that's probably not. Odds are we will not have another office building opportunity in quite a while.
Can I add to that, please? You talk about Valley Center here being obviously an office building, and you're right, it's the only one we have. But we did see that. We're already seeing it coming out of that. There were some people did, it took them a while to even come back to this building. Good thing is they were still paying rent. They hadn't come back to work yet. In fact, there's still a couple of units here today. I hadn't seen them in a year. I haven't seen them since we got the property in March, but they're still paying rent, so good news there. Second thing is, though, we've already kind of gone through that cycle where we felt like people were not going back to the offices, and it might hurt us. We've leased 4 units here in the last week. So it's coming, again, it appears to me it's coming back out of that.
Yeah, and some of those, in some cases, a lower rental amount than we had projected, because if you shop around, there's some desperate people in the office space, especially trying to sublet and things like that. Something interesting just to mention on office and apartments, if the rents are going up, you want short-term leases so that you can adjust those up each time. If rents are going down, you want long-term leases so that they're locked into that long-term. So we've got a lot of leases here that are longer-term. So they can't really negotiate them because they're already in a contract. And so because of that, it kind of insulates us, except for the ones that expire or companies that go out of business. But we've been very fortunate here. Of the $200,000 we had reserved, when we bought this, we had a rent guarantee from the seller because I was concerned about that. And so we had set $200,000 aside. How much did we actually have to keep of that?
$16,000.
We only had $16,000 of people.
That was after 6 months of ownership, going back all the rent that we had missed or what we couldn't collect. It was only $16,000.
Yeah, very, very low. So a lot less than what my upper end fear was. So that's good. Next question.
How about Ridgemar?
Ridgemar, we actually had another tour of that. We had it under contract. That fell out of contract. And we actually found another buyer that is actually paying more for it than we had it under contract before. However, their MO is they put solar on the buildings to go ahead and offset, to get the tax credits and to lower their electrical expense on an all bills paid property. So they're out. When are they going back out to check the rest of the panels? Today. They were out there today to go ahead and check the rest of the panels because they need to make sure that their program that they want to do will fit. So they haven't signed the contract yet, but they've already done the due diligence because they're putting up non-refundable earnest money. They wanted to make sure that everything was good before they went to the next step. So we
How did it fare through the winter storm?
Through the storm?
How did Ridgemar fare through the winter storm? We had a grand total of 6 leaks, pipe ruptures. They affected 4 total units. Again, no displaced residents. Get the water turned off, get it fixed, get it back in, wet vac it, clean it. Probably the biggest issue at Ridgemar is that one of the pumps on the boiler went out. So we had to replace that. Again, it's a temporary fix right now. It's on a temporary pump, and we have to replace within the next 4 or 5 days.
I mean, the
boiler unit.
The whole boiler for the domestic?
Yes.
Yeah. Okay. Was it the pump or the internal portion?
It was the pump, but unfortunately when the pump goes out, then it fries all the other mechanisms. So
yeah. So it's the whole domestic hot water
yes.
boiler.
Which in actuality though, and again just a side note, that's actually was good news for the buyer, by the way.
Because
guess what? They're getting a brand new boiler out of
They get a brand new
out of the
boiler.
deal.
Okay. Is that covered under insurance?
Absolutely covered under insurance. Again, we're not sure about the total amount yet, so it's not going to cost that much to replace. It won't cost over $10,000 to replace the whole boiler. We've got about a $6,500 bid, so it depends on what everything else adds up to whether we're going to hit that threshold and whether it's worth filing a claim or not. And it'll probably be, to be in all honesty, you can imagine everybody's vying for the same plumber, everybody's vying for the same electrician, everybody's vying for the same
Yeah,
contractor.
try and find a plumber right now.
Guess what? The insurance companies are the same. They said, hey, appreciate the pictures. We'll get back with you in about 30 days. The good news is they've been very proactive in saying, look, because, my argument to them is if we have problems, I can't wait for 30 days for an adjuster to come out here and you tell me it's okay to proceed. They are being very cooperative at this point, saying, look, you take care of your residents, you get it fixed, you put the sheetrock back up, just make sure you're taking pictures. We'll be able to tell. So that's good news.
Anybody else?
We had a question come from online. Sorry. You mentioned defeasance. Would you please explain what defeasance is?
Defeasance, in a very simplistic way, it's a prepayment penalty. Fannie Mae loans, Fannie and Freddie and HUD, they all use defeasance. So, because the reason they're in business is to provide stability for the housing market. So they want good debt, long-term debt on the properties so that people like us can provide housing, provide low-income housing. Defeasance is a prepayment penalty that guarantees the bondholders that are the eventual owners of the property that they're going to maintain their yield. So if we pay that loan off, then we have to give them enough money for them to go back and buy 10-year treasuries to get the same yield they would get. The problem is 10-year treasuries are so low that it takes a huge amount of money to make up that difference. For example, on Brookside, we've got, I want to say it's a $20 million loan, $22 million loan, somewhere in that range. The defeasance, the prepayment penalty on that, $5 million. Okay, so it essentially says, nope, you can't sell unless you do an assumption. So what we do is a lot of times when we're either a buyer or a seller, it would be in the contract that, hey, you're paying X for the property and you're responsible for the defeasance, whatever that is, because in 30, 60, 90, 120 days, however long it takes to sell, that number can adjust, go up and down. And because 10-year treasuries ticked up a little bit, then we have actually got a little bit lower defeasance. It's still a ridiculously high amount. It's nowhere near helpful, but it helps a little bit. Okay.
What are your thoughts on cap rate compression and kind of what is your forecast for this year?
Cap rate compression and what is the forecast for next year? Cap rate compression has made everybody a hero the last 10 years. Okay. One of the reasons why our returns are so good at Villa Creek, for example, is we bought it at about a 6 cap, okay, on the actual numbers. And I projected a sale at a 7.5 cap, okay? So first off, does anybody not understand cap rates? Anybody that is just too shy to raise their hand? Okay. Cap rate, just going back a little bit, a cap rate is if you paid cash for the property, what would the return on your investment be, in a nutshell, okay? Because everybody that does it will have different debt, things like that. That'll change the yield that you get. So if you're buying a $10 million property and you're putting $5 million down, you're actually using $5 million of debt that's low interest that increases the yield. If you buy a $10 million property and you buy it for a 5 cap, then that means there's a $500,000 NOI. Well, now it's going to be different if you put a lower down payment because you're borrowing at a much lower rate, your yield is higher. And what happens is that cap rate, if you have a $500,000 NOI and you're buying, I'm going to use a 10 cap for easy numbers. We haven't seen 10 caps in a long time. But $500,000 NOI at a 10 cap, so $500,000 divided by 0.1, same thing as times 10. So that would mean that that property is worth $5 million. Okay? That's at a 10 cap. Now, cap rate compression, meaning the cap rate goes down, that would mean that if it goes down to a 5 cap, okay? Now it's $500,000 divided by 0.05, which would be $20 million. Did I do that right? $10 million. $10 million, okay? So the value of your property, because the cap rates went down, the value of the property shot way up, even though you did nothing to increase the NOI. Okay, so cap rate compression has made every investor a hero the last 10 years. I see some properties, and I've seen some sponsors basically do a deal, they bought it, they ran it into the ground even worse, and then they sold it at a profit because of cap rate compression. Okay? Now, and that's what's happened so far the last 10 years, is the cap rates have gone down and down and down and down and down. I always had to project, and I think smart money managers do, is you have to count on that cap rate actually going up. Some people say use the same cap rate when you're analyzing a property, use the same cap rate going in as you would when you sell it in 5 years. I disagree with that. I always look at that at bumping it up 10 bips or 0.1% each year. So if we're buying at a 5 cap now, I'm projecting at least a 5.5 cap in 5 years, because if interest rates go up, anything like that. So to protect us on our numbers. So when I'm projecting a 16% return, I've got a higher exit cap rate than our going in cap rate to protect us on the downturn. Now, if cap rates stay the same, then that return is even better. If cap rates go down, it's even way better. But you have to protect from that upside. So the question is cap rate compression, and is it going to continue? And I've had a lot of people say, no, you know what, I guarantee, I bet a guy, there's a property I was going to buy, I bet him dinner for him and his wife anywhere in the world, okay? We were trying to buy it at a 5 cap, and I said it doesn't work because I have to bump it up to a 5.5 cap. He said, I'll bet you anything that you're going to sell it in 5 years at a 5 cap or lower. And we'll bet dinner anywhere in the world. And so my wife's like, I want to go to Versailles and have dinner there. He's like, no problem. So I'm sitting here going, okay, this is about a $50,000 bet. But from my point of view, is if cap rate stayed the same, I'd make at least that, so I'd be happy with it. The problem is the deal didn't make sense for me because I still had to budget for that higher cap rate. From what economists and everybody I'm talking to are saying, is that cap rate is going to stay the same or drop a little bit. But I still have to budget for a higher cap rate on the exit. And that's just being conservative. So when I had one guy tell me, I invested with you because you projected a 16% return and you gave me 20. Whereas the other guy projected 20 and only gave me 16. So that's one of the things about our underwriting. We try and be very, very conservative. Yes, sir. What factors lead to the compression? Cap rate compression, basically interest rates on your debt go toward what the 10-year treasury is. Okay, correct me if I'm wrong, Julian. Okay, so the 10-year treasury, the way that the debt is calculated is they take the 10-year treasury and then they have a markup to that. Say, we're going to, because they basically, the lenders say, hey, I'm going to go ahead and issue bonds on this 10-year treasury to go ahead and get the money you want for the loan. But I need to make a profit, so I'm going to go ahead and give, so I want 50 basis points above what the 10-year treasury is. Okay, so because the 10-year Treasury has been going down and down and down and down and down, those rates have gone down and down and down and down. And because of that, the yields have gone up. So you've had a couple of things. One is if interest rates go up, you need to make a spread as an investor. The lender is looking at, hey, I'm borrowing at 3% and I'm lending out at 3.5 because of that 5 bip spread, okay? Or that half a point spread. As an investor, we're saying, okay, we need to make a yield on that investment, so we need to buy it at a 5% yield so that we can make profit on the money that we're putting into it, okay? Because interest rates go down, the cap rates go down because it maintains the yield that the investor can get, okay? So because interest rates on the T-bills have gone down. And why did interest rates on T-bills go down? And here's where I'm going to get a little fuzzy as far as the market, not manipulation, but when you want a safe, solid return, you're going to buy a 10-year U.S. Treasury. It's guaranteed by the U.S. government. Well, in scary economic times, that people flee the stock market, say, I got to get out of the stock market, I got to put it in these treasuries so that I have a nice, safe yield. And because of that, it drives those prices down because those T-bills are a reverse auction. Okay, it's how much can I sell that for? Okay, how can I say that? It's a reverse auction that, yeah, I'll buy that T-bill at 5%. Somebody else says I'll buy that T-bill at 4. I'll buy it at 3. So it drives the price down of that with the more people that are getting into those T-bills. You follow? Hopefully I explained that right. Is that a good explanation, Julian?
It is. It's a little more complicated for the average person. Mind if I try?
Go for it. Oh, we give him, wait, you got to get the microphone.
Okay, so not because I'm
He's smarter than I am.
a whiz
so.
or anything like that. I'm just a poor old boy from a poor old family. No,
I was blowing up. No, I can't say that.
Dillard would understand where I'm coming from. So rather than go the complicated route, this is the way I like to explain it. Cap rates are really, forget all the complicated math. All it is a result of the demand on real estate. Okay, and if you look at real estate acquisition and norms, so an average property is going to require anywhere between 20 to 30% down. Right, everybody with me? Okay, you don't see too many at 40%, and you don't see any at 15%. So you're always going to be in that range. So if you want to buy a property, say let's round $10 million, someone has to put somewhere between $2 million to $3 million down. Forget closing costs. The rents then will give you your income, and then of course you've got your expenses. After you factor all that, and then your interest rate from the market, which the market is what's going to tell you what interest rates the banks are willing to loan. Then what you do is you calculate the return on that money. And everyone out there investing has a more or less requirement before they will invest in a piece of property, and that return tends to kind of equal out across the board. Nobody is in our market saying, I'll take a 3% return on my money because it's too low, and nobody's saying, I want a 20% return on money because you're not going to be able to get it anyway. So the market kind of equalizes everything out, and you will find that as I analyze properties all the time, it always comes out to what do you have to pay for properties. So you start with what the sellers are asking for and what they're getting for these properties. So if your average B-class property is selling for $130,000 a door, then you know that's where you're going to start, and whatever that amount happens to be, then you apply your down payment, and then your rents are only going to yield so much for that particular property. Your interest rate's only going to be gotten for whatever the market is going to give you, and then that, when you reverse the calculation, that tells you what your cap rate is. I tell people don't worry about the cap rate. Basically, what you need to know is this: in today's market, I'm not going to tell you what it is. This is what you need to know. In today's market, what are properties that I want to buy selling for? What is the interest rate that I can get to acquire these properties? And then what will the NOI that property give me? That's what's going to dictate what the cap rate is. And so therefore, you could get crazy about all the calculations, but basically the market dictates based on what the supply and demand is. And so what are the properties selling for, and what are the interest rates that apply for that given the amount of down payment. And it all comes out right depending on class, A class, B class, C class. And right now the cap rates are ranging from about 5.5% on the high side to about 4.5%, maybe even 4% for the lower A class. And it's all based on supply and demand. There's a tremendous amount of capital chasing these assets, and so that's what you're having to pay for these properties. And when you finish the analysis on the deal, you're saying, oh, that's my yield, then that's what the cap rate is. So therefore, you could really try to go deep into what cap rates are, but really it's just a function of what you've paid for the property and what the NOI is, and that's going to give you a cap rate. That's the simplest way to look at it. Basically, don't worry about cap rates. All you need to worry about is what are properties selling for in today's market in the class that you want to buy. That's what you really need to know. And then you know that the average down payment for those properties is going to be 20 to 30%, and the rents are going to be what they're going to be for that particular market. And if you run a property correctly, your average per unit expense per year is going to be about the same. So the market is kind of equal. So Darwin and I are competing for a property. He might be able to get just a skosh better on interest rate, but rents-wise, if he's buying a property in the same market, we're going to be right about there. And if he's running the property the way it's supposed to be, and I'm running the properties, then the expenses are going to be about the same. So it really just equals out. So if you're worried about cap rates, I would say worry more about the price per unit that the market is offering these properties at. And right now the supply is there, but the demand is even stronger. It's gotten crazy out there, and the cap rates, in my opinion, I don't know if you agree with me, but they're going to continue to compress. The jobs continue to come to Texas. The residents come. I have a lake home in East Texas, and I go there quite a bit. Every time I'm on 130 coming back, all I see is U-Hauls and Ryder trucks and trailers, and they're all from New York, New Jersey, all of the states up in the Northeast. And I see it on a weekly basis. Everybody's coming here, and they have to live somewhere.
Okay. I don't look at cap rates at all. When we analyze a property, we don't look at a cap rate at all, because we look at what the yield, what we can get to make the investor to know whether or not that's a good deal. Right. So we don't even look at cap rates when we're analyzing properties.
But if you want to, what you've paid for the property and what your NOI divided into that's going to give you your cap rate.
But those cap rates are going to fluctuate based on what the interest rate is, because the investor is going to need a yield.
Exactly.
And so cap rates are going to go down. I agree with you on the possibility of more cap rate compression if interest rates stay the same, because there's so much money in the market.
And that's what we call
they're driving down
inversion.
The yield. Yeah, they're driving down the yield, because if I want to buy something and Susan wants to buy something, it's, hey, who's going to pay more for it? And there's so much stupid money chasing deals that it's driving up the prices, which is lowering the yield, which has taken us out of the equation.
Yeah. A friend of mine, I was talking to him just last week. He's with CBRE, which is the largest real estate company in the world. And he was telling me there's a fund out in New York that was $500 million, $500 million just to buy real estate this year. And it was going to be in apartments, hotel and hospitality, and strip centers. And they completely dropped everything except multifamily. And now they're going to plow $500 million in the Southwest only in multifamily. So that's
and they have to buy. Yeah. They don't have a choice. So it doesn't even matter what the yield is for them. They have to buy. So if they will buy with a very low yield, a very high price, we have to say, you know what, nope, we'll put our money over here to the side and wait for the next deal. And that's why trying to find off-market deals or preempting deals is so important. Because if it's marketed, then the jobs of the brokers are to get it out as far and wide as possible to find the one that's the most motivated to buy it.
Yep.
And just like I was mentioning on the Brookside potential buyers, 3 people, 3 groups, $1 million, non-refundable, day one. Okay? And that's not a risk I want to take, because you get in there and there could be problems you can't overcome, especially right now with fixing leaks and things like that.
Yep.
So,
Did that make it a little easier to understand?
whose was easier? No, I'm kidding.
Oh, absolutely,
Yes,
great time.
absolutely. And with all the money being pumped, if they pump in that other $1.9 trillion into the economy, I was looking at a report, by the way, that they're projecting 6.6% GDP growth this year. With all the businesses flat, things like that. And if they do get the higher minimum wage, that's going to cause inflation, and prices are going to go up. And what's great about inflation, there's some people that are older than I am that remember the 70s and what happened with real estate in the 70s. Anybody have real estate in the 70s? Anybody? Okay. And what did you think? Good? What's that? Sucked? Yes, 70s with the massive inflation, because all of a sudden the property goes way up in value, but your debt stays the same. Your equity grows like
How about
crazy.
my first duplex at 17%?
17% interest rate.
17% in 1980.
And T-bills were at what, 7?
That was crazy.
Yeah, so. Okay, next question. And
Sorry.
so 2 questions, very long answer.
Any questions about anything?
I'm sure Ian has a question back there. Thanks for coming. Ian drove all the way from Austin. Houston. You were in Houston.
South Dallas.
Way South Dallas, yes. Just to be here. Okay, any questions? Anything online? How did we know about those?
No, all good.
Then let's just talk about how they feel about the market right now.
Yeah.
How are you guys feeling about the market? In other words, out of all of this information, forget that. How do you feel about being in real estate right now? Is everybody feeling still bullish?
Okay, raise your hand if you think it's good and it's going to keep on being good. How many think it's going to be bad?
It's okay. We won't laugh at you if you think it's bad.
Well, I might, but it's okay.
Well, it's scary good. Scary good because, in my opinion, the COVID is about to get into our rearview mirror. And when I say about to get, maybe about.
Yeah.
Everybody I know, I mean, you like travel. I love travel. I used to travel all the time. Last year, I don't know how many trips I took, and I started booking airfare for summer and latter part of the year. The prices have skyrocketed now for airfare. Everybody is ready to start spending money and getting out, and the buyers are still out there for the real estate that's
And especially coming into DFW.
Oh my gosh! I talked to a guy in, as you know, we closed Village Condos yesterday. Was it yesterday?
Yep.
Yeah, yesterday. So we want to complement that property with one more. So it's 80s, 202 units in Waco, and
This is a property he's analyzing today.
Yes, I was. Had to give it up because it rolled out on Monday. Started doing the analysis. I called the guy because I wasn't able to reach him. I finally reached him today, and he tells me that it got preempted. He had 3 offers on the property the day it rolled out. 3 offers on the property. So, yeah, that's why I say scary good. Scary good.
Competitive.
Yep, exactly. Now, what I will say that right now, the one thing that is kind of in neutral is rents. We're not seeing the 3, 4, 5, 6% annual growth on rents. But as soon as people get back to work, as soon as the unemployment rate comes down, and all this other stuff starts going away, rents are going to start going right back up.
Do we have any residential real estate agents in here? Okay, how hard is it to get a client a house now?
Next to impossible.
30 offers on one house.
Yeah, 30 offers on every house.
Good luck
Yeah.
getting it.
Prices have gone up so high that now it's pushing people back into renting. So, so that's better for our rental market.
We usually have a 3-month supply. We have 1
Interest rates are still low, and that's what's part of what's driving it up. And with the growth in DFW, yeah, it's going nuts. Yeah.
Yeah, and builders can't build them fast enough. And they have their clauses in their contracts that will escalate the price based on the price of raw materials for them: lumber, shingles, cement, drywall.
And now with all the leaks, drywall's going to go way up. Wood's already way up.
So it's a great time to be in the market. What I like about Blue Tahoe is that it is such a unique opportunity that we can't duplicate here. It's
No, you
next to
can't.
impossible.
Yeah.
And so that's where I'm putting my money. I don't know about you guys, but I'd give it a second look if you're not already.
I think it is. I think I generally try and be conservative, but every once in a while there's something like Ridgemar that doesn't do as good. That's why I think you should put, if you've got, let's just say you have 300, I gave the same exact advice to a guy. He said, I've got 300 grand. What should I do? Should I put it all in one deal? I said, no. Spread that out over numerous deals, because you never know, there might be some anomaly that doesn't make it as well. And some are absolutely great. And we've got some grand slams. We've got some base hits. But we've only had one loser in 30 years. And there's been a few base hits, but a lot of grand slams and a whole lot of stand-up doubles. So I think that you spread them out over numerous deals and spread that risk out.
And you get the Baseball Hall of Fame batting 300, so they don't all have to be grand slams.
That's right. That's right. I wasn't going to tell anybody about this.
But yeah, see,
I won't say the name, Brian, okay? Should I tell the whole story all the way back?
say 30.
Yes?
No.
Not the whole thing.
Give us the Reader's Digest version.
Okay, well, I can't give you the whole version because it would give something away. But we just put under contract a Class A property at a very good price in a very good location. And it's a very nice property. It's in lease up.
Oh, wait. Why were we able to capture that? Because it's off market.
Because it's off market, exactly.
Where is it?
I can't tell you. The reason I can't say anything on it yet is, number one, is we just put it under contract. We're doing due diligence this week, and we don't want to get everybody's hopes up. But I will tell you this. We've already got a commitment from a partner that's probably going to put up 90-95% of the capital to buy it. One
to the
person.
tune of how many millions?
How many millions?
Yes, that's about
7 million.
7 million.
But it remains a syndicated property.
It's-
Although one partner owns 90%.
One partner is going to have, the one partner is going to put up a lot of the money. So I think that I'm probably only going to, it's going to be, it's a, shoot, I don't even remember the price. Oh my
30,
God.
37.
37 million. Yes, that's what it is.
37.
37 million. And because of the debt we're getting, we're only going to need to put about $7 to $8 million down. And he's going to put up $7.5 million. So we're only going to be raising about 500 grand for that.
And we're also,
What?
we're going to take over management of it.
Oh yeah, we all, and just like Oakview, we're going to take over and manage it because it's in lease up.
Prior to owning it.
It's only 40% occupied right now. The whole idea was to wait.
So it's new.
It's brand new.
Brand new.
CO in September. Okay, it's brand new. It's in lease up. It's only 40% occupied. 100 people have been chasing this deal. They all want to wait until it's leased up, though. And so we're in there because we're buying it during lease up, and they've done a horrible job. They should have already been leased up. So how long is it going to take you to fill that up, Brian?
120 days.
120 days to get it filled up.
My regional manager's saying 90 days. Again, I'm being a little conservative here.
Darwin, how many units?
It's over 200. I don't want any more questions from you about it. You-
Oh, unit mix?
Ones and
Yes.
twos.
One-
Ones and twos.
One bedrooms or all ones?
No,
No,
ones
no,
and
ones and
twos.
twos.
Ones and twos.
Great location, super location,
Super location.
beautiful property.
Yeah, brand new. Yes, sir.
How many people are buying in Lake Tahoe? Is there not that many buyers?
No, well, the reason is because they're all 6 and 8 and 10 unit properties. They're all small properties, and how do you manage a 6 unit property? Okay, I mean, you got management fees. It's 10, 12%.
When your brother's already got a setup there.
He's already got everything set up. He's already got about 100 units. We're actually buying some of the units from him at his cost, so that way we can turn those over. And the whole reason Charlie's doing that is, who saw his video? Who saw his presentation? Yeah. So I mean, he took, for those of you who weren't there, is in 20 years, he did 20 deals and turned $20,000 into a $20 million portfolio. Okay, he pisses me off because he's got the Midas touch. But as you saw in the video, he actually gets out there and works on him himself.
Well,
he
that's
gets out
true,
there and does it.
but in all fairness to you, you're the primary focus on your acquisitions are syndications.
Yeah, mine.
He was doing
He's
1031s.
all doing 1031. That's how he did it. 1031 exchanging to something bigger. But at this point, he's now saying, okay, I want to keep on buying. There's a lot of opportunity, but my funds are tapped. So that's when he said, okay, now I'll listen to syndication, and so that's why we started doing that, because he's there and he's got the opportunities. They're right there in front of him. There's a this is the kind of thing he finds. We put it in there that we can buy numerous types of real estate, and one of the reasons why is in Lake Tahoe he found a hotel that was inherited by two sisters, and it was a flagged Best Western, I think, and Best Western wants to buy out of their contract, so they'll pay $800,000 to get out of their lease on that property. One of the sisters wants to sell, the other one doesn't, and so this has been a hellacious. He's been working on this thing for 6 months, and so he can buy out one sister, keep the other sister as a partner. She's completely silent. She doesn't live there or anything else. She wants to be completely silent. And not only do they have the hotel, they've got a bunch of extra land that they can sell. And I want to say, I'm picking numbers out. I'm going off of memory here. I want to say it's, the total purchase price would be $7 million. He'd buy one sister out for 3.5. He thinks the property together, once it's all done, is worth 15 to 18. Okay, so that's something that, but it's a hotel. And he's already done one hotel in Lake Tahoe, paid $6 million, sold it for $9 million, like 2 years later. So he knows how to do all these. Oh, the one that he bought, it was mirrors on the ceiling. They did 500 weddings a year, and so it was one of those, they had all the theme rooms, and he went through and had to update it so that it wasn't so cheesy, but he did all that. So bottom line is he's up there working on this and looking for opportunities, and so that way we get to underwrite it, we get to vet it, we raise the money, we represent the owners, the equity, and he's the one out there doing the work. So that's a good operating partner to have. Plus, of course, I trust him with my life, so that's no big deal. And Garrett, my stepson, he's actually out there working with him right now. So he said, why doesn't he come out? Of course, he just wanted free labor. Because that's how we grew up. He and I grew up going and doing all the work ourselves. And my dad always said, work smarter or work harder. And I'd rather wear a suit and tie than work gloves. So that's kind of the dichotomy.
But not like we're going to abandon DFW.
No, Absolutely not. What? Any other questions?
I think that's it.
Any more? That is it. So look, we're looking forward to another great year, and we'll get some of these other properties sold. We'll buy some more. We're always looking for opportunities, analyzing the heck out of them, and quite honestly, most things don't make sense, and we really have to look for the off-market opportunities or things we can preempt, because if not, they have stupid money chasing deals. So that's all we got. Any
I just want to close with one thing. Are any of you here in this property, in this building, invested here? If you would like a tour, I'd be glad to give you. I know it's getting late, but if you'd like a tour, I'll be glad to do that after. Anyway, thank again, everybody, for
One more thing. Who is here for the first time? First time.
first time ever at a Darwin German meeting.
Yeah. Who's here?
First time at one of our meetings.
Could we get a chance to meet you though before you leave? Reach out to Julie and myself. Just love to introduce ourselves and answer any questions that you might have. Yeah, absolutely. Again, and I'll be glad to give anybody a tour that wants it as well. So thank you for coming. Thank you for braving. One last thing. One last.
I've got some surveys that I'd love for you to please help me out on. If you will fill them out, completely anonymous. You don't have to put your name, thumbprint, anything. Just fill out a few.
Here, why don't we grab
Let
those?
me tell you why we're doing that survey, though. We want to make sure that we're out there looking for things that you're looking for. Again, you're the family of DGRE partners, okay? If it's something that you're interested in, we need to get interested in it. We just kind of want to have an idea how you feel. What do you feel about the market right now? Are you likely to invest? Not likely to invest? Want to invest in the next 30 days? Want to invest over the next year? You looking for a yield
Take one of those?
or a
Here's that
value?
survey.
I hope not a lot of people are looking
pen?
too much for value. They're just not there right
It's a
now.
free gift for you.
It's really hard to find a good value deal.
Here, take
If
one
I
down, pass it
if
around.
I ask a question, who's looking for a value
one
deal?
down, pass
Everybody
it
would raise their
around.
hand. I wish they were out there, but they're
There you
just
go.
really hard to find.
Take one down, pass it around.
No, yield's not bad either.
Judy,
But we
take
want to
one
make sure
down,
we're
pass it
looking for
around.
deals that fit
Correct,
what our
thank you.
family of partners are looking for.
Eduardo.
So this will
Take one
help
down,
us
pass it around, please.
do that. So again, thank you for coming. Thank everybody that's online.
Go that way.
And again, I'll be glad. We'd love to meet you if you're a first
went the
timer
wrong way.
here. And I'd be glad to give you a tour as well. Thank you, thank you, thank you.
How you doing?